Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's May 30th, 2023. We got a big show coming to you live from Nicaragua this morning. We're going to talk about the markets breaking out once again. Nvidia hitting the $1 trillion valuation level. Holy smokes. Unfortunately, we have an obituary to talk about, some legend in the industry. Then we're going to talk about the debt ceiling. We cannot ignore what's going on there. Is a deal done or is it not? And then, of course, the biggest topic over the last few weeks, artificial intelligence, AI. I found a potential, what we call safe way to play the boom in artificial intelligence, and I'm going to name some names. All that more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says, we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. Welcome again to Making Money. This is Matt McCall. Thanks for joining me. It's a Tuesday morning here in beautiful Nicaragua. It's the 30th of May, 2023. And what a beautiful morning. I went for my walk to get my tea around 5:30 a.m. The sun's already up, comes up so early here. It also helps when you fall asleep at halftime at a game at 8:30 to get up early on a Tuesday. But it's about 8 a.m. here, 10 a.m. Eastern time. We got the markets up. We're going to talk about that in a minute. But over the weekend, some sad news, a passing of a legend in this industry, William J. O'Neill. He was the founder of Investors Business Daily, IBD. You might have heard of them. I'm sure you heard of him if you're watching this show. I would say my condolences out to his family and the business. IBD's been around since '84. I was only 8 years old then, so I wasn't reading it then. But it was one of the first newspapers outside of Wall Street Journal in the finance industry that I would read all the time. And before it was online, every weekend they would have the IBD 100, I believe it was called back then, or IBD 50, whatever it was. And I would travel to different little newsstands to try to find it. Even when I was in New York City for many years, a local newsstand sometimes wouldn't have it. I'd have to go 10 blocks to the left or right to find it, just to get that list and go through that list of those 100 stocks in there that were ranked by the IBD ranking. So definitely a huge influence on my career. And, one of those things I'll never forget, waking up and running for that actual paper, getting the ink all over my fingers. But on a bullish note here, we have the markets breaking out. We have the S&P, we have the NASDAQ both up this morning. And we'll take a look at both these charts here real quick. Here's the S&P 500. Right now, we're up about 0.2%. We're near the lows of the sessions. We gapped up on the debt ceiling deal, but that has not been signed yet by Congress. So that has not officially gone through as of yet. McCarthy and Biden over the weekend agreed in terms to a deal, which we're going to dive into in a second. But again, not signed as of yet. But we do have the S&P intraday hitting the best level that we've seen since mid-August. So again, a very, very good sign. If we could hold above this 4,200 level, 420 here on the SPYs, that'd be a very good sign. If we take a look at the QQQs, which is the NASDAQ 100, again, the 100 largest non-financial stocks in the NASDAQ composite, up about 0.5%. Again, on the lows of the session, about 32 minutes in, but hitting the best level since early May of last year. So we're at a 52-week high intraday level, and we closed at a 52-week high on Friday on a closing level. A lot is being driven, obviously, by Nvidia and some of the big large cap names and some of the what we call the artificial intelligence AI names as well. There's quite a few charts on there. 5 charts I want to go through, just kind of explain where we are with the market right now. And they're not all bullish, but some will definitely lean towards the bullish side. And not like I did this for any reason. But I just the way I looked at charts and where the market is right now, it tends to be bullish, and that's what happens, folks, when you have a market that is breaking out. It's just the way that it works. So first of all, I'm going to take a look at here is it's pretty interesting. This is a study from the Bank of America, their global fund manager survey, and this chart, as you can see here, it shows that the fund managers in a survey that they conduct are overweight bonds, meaning more money going into bonds in May of 2023, which is obviously this month. I still got 2 days left. This month, the most overweight that we've seen since the great financial crisis going back to March of 2009. And we know what happened in March 2009, folks. Stocks bottom. The S&P in March, I think it was March 8th or March 9th of 2009, or maybe it's March 6th, somewhere in those couple of days, hit a low of 666 in the S&P. And since then, now I just mentioned we're above 4,200. I'm not saying with the same return over the next 14 years, but I think the possibility is definitely there. But what I'm showing is when there's such an overweight to one asset class like this, you tend to see the sectors that are underweight, which I'm about to show you right now, tend to outperform because there's just a natural contrarian view to this, that money will shift from one to the other. Now, here's a bigger breakdown of what I just showed you. You can see the bonds on top, obviously extremely overweight. And then you can see on the left-hand side, the red and the bottom left. And these are the underweight areas of the market. The number one underweight is just U.S. in general. Number 2 is equities, which is stocks. 3 is REITs, 4 insurance, 5 USD, US dollar. The bottom 2 what really catch my eye. You look at, again, U.S. stocks, because we also have emerging market stocks and Eurozone stocks on here. But U.S. stocks, very underweight compared to other regions of the world. And equities, compared to other asset classes, extremely underweight. At the top right, we talk about bonds being very overweight, also staples. Those are consumer staples. Those are Procter & Gamble's, the very boring stocks out there, if you will. Nothing wrong with those companies, just more boring. The Hershey's, Procter & Gamble staples. Then you have cash, very overweight as well, and utilities. Areas that have held up very well. And again, a lot of money sitting in cash right now. So that overweight to me of bonds and very underweight to equities indicates that I believe that we're due for what could be a really, really big rally in stocks coming up in the next couple of years. This is something that ends in weeks or months. It takes a long time. On the flip side, the next chart here I'm going to show you is something that a lot of people have been pointing towards. This comes from Charlie Biello, a guy I follow on Twitter. He's a great chartist, comes up with some great information. This shows, just as about a week and a half ago, the S&P weighting, the top 2 holdings of the S&P, what percentage they make up of the entire index. Remember, there's 500 stocks in the S&P 500. 2 stocks right now, Apple and Microsoft, make up 14.1%. That's the highest we've had since going back to when I was born in the mid-'70s. In 1982, we had IBM and AT&T make up 10.9%. Neither of those stocks have outperformed the market since then. You go back to 99, we had Microsoft and GE. Microsoft still doing well. GE, obviously, no. And then we go to about 2008, I believe it is, ExxonMobil and Walmart, still holding in okay, but not outperforming the market. Again, so does that mean Apple, Microsoft maybe will underperform the market in the next 10 years? Great chance, I think so. But a lot of people view this as negative because they think that the rally in the market has been led by just a few stocks. And it is true, but maybe it isn't, because I have something here I'm going to show you here in 1 second that may just kind of turn you the other way. Because as much as the big caps are leading, there's a chart here that's going to show you right now that maybe that's not true. So in the month of May, this is through the 26th, so last week, just a few days ago, 90 stocks in the S&P 500. So nearly 1/5 of them. So there's a little less than 20% of them, 18% to be exact, have hit 52-week highs in the month of May. But look how it's spread out. Yes, technology has 19. However, consumer discretionary has 17. Top ones on the list through alphabetical order: AutoZone, Booking.com, Chipotle, DR Horton, Darden, the restaurants, Lennar, another home builder. We look at healthcare, 16. Look at that. We have some biotechs in there. We have Boston Scientific, which is a medical equipment company, Eli Lilly, the big pharmaceutical. So really diverse. Even the industrials. We have 12 industrials, and GE's in there, hitting a 52-week high. So we can look at it we can always take this market, and I can seriously convince you to be very bullish or very bearish if you came in with a neutral view, because there's so many charts out there you can look both ways. So that's really why I wanted to show you this, because people are saying that it's led by a couple. All that being said, though, folks, it is, but it isn't, because about 19% or so, 18% of the S&P is hitting a new high in the month of May. And the last chart I want to show you here, and this is just the underperformance. I've talked about this in the past, of the S&P 500 large caps versus the small caps. And look at this. This is the S&P 500 by market cap. So all these companies in here are considered large caps, but the 50 smallest stocks have the average gain of a negative 11.39% over the last 3 months. The 50 largest have an average gain of 11.8%. So that's about 23% difference from the 50 largest to the 50 smallest. That tells you a lot. That just really tells you that the money is going to the large companies. So again, we can look at the numbers all you want. Some of them tell you the large caps are leading the way. Some tell you, well, maybe not. It's more diversified than you think. I still believe we're in a bit of a stock pickers market. And I hate to say that because it's such an overused term. But I still think that we are there, folks. And that being said, we can actually broaden this out a little bit. I don't like saying stock pickers, but what if we say a trend pickers market? Because obviously, if you're invested in AI companies, are doing well. It's not about picking just AI. Anything related to AI has been doing well. A lot of healthcare has been doing well too. Certain areas within healthcare. So there are definitely pockets in the market that are doing well. So if you're in the right trend, I think you're okay. But again, I'm not investing for 3 months. That number I showed you, a small cap, large cap, I don't care about 3 months. I'm investing for 3 years, 5 years, 10 years. And we talk about Nvidia being a 100x company over the last decade plus. It takes that long. But a 100x return changes most people's lives, at least the life of their portfolio, the performance of their portfolio. Because say you have 20 stocks and you have one that goes up 100x. The other 19 go to zero and you still make a hell of a return. Hopefully that's not what happens, but you get one of those 100xers in there over a 10, 15-year time frame. The others do okay. Boy, oh boy, you got a hell of a return. That's your financial future right there, folks. I'm going to talk more about that next week because I've been diving into this. And I talk about 10x, 100x for the last 15 years of my career. And I have some 100x in my track record. Lots of 10x in my track record. So many doubles in my track record. They take time, though. And you have to be patient. Sure, some have happened fast. Some have taken 7 years to double. Still not a horrible return. It's about an average of the market, really. All right, we'll talk about that next week. But before we jump into AI and what I want to talk about that and what I consider the safe investments in AI, I want to talk about the debt ceiling. So I mentioned Sunday, McCarthy, Biden signed an agreement to suspend the debt ceiling and to cap the federal spending. And then, of course, the U.S. will not default. I never thought they would default. I thought it was a bunch of bullshit, honestly. It's a bunch of media crap. And because we haven't yet, and why would we suddenly now? And what politician wants to be in D.C. when that happens? Because whoever they run against in the future will say, you were there and you let that happen. So come on, it's not. And the people on Twitter and the bears out there that talk about this are just absolutely, it's disingenuous. It's a bunch of fluff, and people love to be in the spotlight. As I say that, I have a huge spotlight shining on me right now. But anyway, the deal would suspend the $31.4 trillion debt ceiling until the 1st of 2025, January 1st, 2025. So that's past the election, which is good. We don't have to listen to this crap during the election, which is going to be enough during the election run-up. So that goes through all of 2024. So let's take a look at a few things here, maybe a couple winners that come out of this. So the deal would boost total defense spending to about $886 billion. That's kind of what Biden had his budget, so I can see why that goes through. It's about a 3% increase that was allocated for the budget by the Pentagon and other things. So about 3% increase year over year. And they also said that they would take $10 billion in each calendar year, 2024, 2025, away from that $80 billion that went through in the Inflation Reduction Act. How this reduces inflation, who the hell knows? And more BS that coming through politicians. In the Inflation Reduction Act, the $80 billion going to the IRS to go after middle-class people. They say rich, but it's bullshit again. Go after middle-class people. How about this? You take the tax code from this big and you make it this big. Let's do that. Go to Estonia, learn something. Let them teach you how to run the Internal Revenue Service. Bunch of BS. Don't get me going. And I think this is both sides of the aisle. I don't care what side you're on. Nobody likes to spend time and money to do your taxes and have no idea where your tax money is going. Ridiculous. So, yes, if we're going to defund anything, defund the damn IRS. But we're taking $20 billion away, but they still have $60 billion. They're also going to do some COVID clawback up to $70 billion in unused funds. Good. If it's not being used, bring it back. More requirements for people getting food assistance. A couple other things. Oh, student loans. You have to actually pay your student loans now. Oh, go cry me a river. You decided to take a major at a very expensive private school that you knew you couldn't get a job in, and now you're pissed off at the world. Too freaking bad. Pay your damn student loans. I paid mine. My siblings paid theirs. We got grants because we worked hard. We worked during college. I bartended almost 40 hours a week while going to school full time. It's called life. And if you choose to do that, then pay it. We're not here to pay for your education because you can't get a damn job because you picked a shitty major and you don't do good interviews. That's not my problem. Why should I be penalized? If you're not going to pay your student loans, then give me my money back that I paid. Is that fair? No, that's not fair. So this is actually, that's great to see. So a couple potential winners. With the student loans, potentially SoFi. SOFI is a symbol there. They might get some play here for people looking to refinance their student loans. The stock is up about 5.5% on the news to about almost a 1 month high on that news. Talks about the defense spending. You know, I like the defense plays. I think they're going to continue to get money. Unfortunately, we live in a very unstable geopolitical environment right now. I don't see that ending. Apparently, 2 drone attacks on apartment buildings in Moscow over the weekend. More bombs in Kyiv. So I don't see that going away. I love to see it go away. I don't see it going away. So I think the defense plays our way. They're also looking at the Mountain Valley pipeline, and that would be approved to finish that going through West Virginia and maybe Virginia as well. The lead on that is a symbol ETRN, which is Equitrans Midstream. That stock is up 37% this morning in the news as they're the lead developer on that pipeline. If that goes through, probably already priced in at this point. And then lastly, taking $20 billion away from the IRS, maybe it means they can't push through this digital e-filing, which I would like them to actually do that. But H&R Block and Intuit, who does tax software as well, could be winners of that as well. All right, so let's jump into AI. So I don't get all worked up here on a beautiful Tuesday morning about the government, because I think we're all, again, both sides of the aisle, folks. I think we're just fed up with the U.S. government at this point, and I can't blame anybody who is quite fed up. But a group of executives came out just today, on Tuesday, and they wrote a letter, an open letter, and they likened the potential threats of artificial intelligence, and they put them on par with pandemics and nuclear war. This is a quote from the letter. Mitigating the risk of extinction from AI should be a global priority alongside other societal scale risks, such as pandemics and nuclear war. It was released by the Center for AI Safety and was signed by OpenAI. Their CEO, Sam Altman, obviously has been in the news a lot as ChatGPT out there. Others out there didn't really mention who else signed it, but others have signed it as well. Apparently big names, executives from Microsoft, Google, you name it, all the big ones out there. And then don't forget back a couple months ago in March, Elon Musk and Steve Wozniak, they wrote an open letter as well. They will call for a 6-month pause to the development of a lot of AI to put in some new safety standards. And I was thinking this morning, I've been writing about AI, recommending AI stocks for many, many years. And obviously, I always thought it was inevitable. And it's kind of clicked this morning that when it comes to a lot of these trends, whether it be AI, whether it be autonomous vehicles, which will at some point be widespread, EVs there, but they'll become very widespread in the future. A lot of other my trends that aren't quite here yet, flying cars, EVTOLs, they will be reality. When that happens, it's a catalyst. November of last year, ChatGPT downloaded immediately by 1 million people so quickly, and it really just took off. That was the catalyst. You have to be patient, though, because you don't know whether that catalyst was going to happen last year or a year from now. But you can see what happens when you own some of the big names, Nvidia, AMD, other companies related to that, how well they've done. And speaking of Nvidia, I'll show you the chart here real quick. Nvidia hit a milestone today, became the next company to hit the $1 trillion valuation this morning, joining some of the other big names, such as obviously Apple, Microsoft, Google, you name it. And Tesla was there, not anymore. It fell back down, but Tesla was there at one point as well. So ChatGPT, artificial intelligence, ChatGPT says it's an AI program, and the GPT, if you didn't know, stands for Chat Generative Pre-trained Transformer. GPT sounds much better. Before I jump into two little topics I think are funny, or one topic I think is kind of really attuned to this show, Microsoft got an upgrade this morning from Wedbush, and that's Dan Ives over there who runs this. And he came out as a quote, said, "We strongly believe the first step for Microsoft was Azure Office 365, the next step being ChatGPT AI monetization on both the consumer and enterprise fronts. And he believed that it can add $40 to $50 per share to the sum of parts of Microsoft's valuation." And if we take a look at Microsoft chart, where it is right now, the stock opened up this morning, now actually down about $2, but about $330 a share. So $40 to $50 per share. Obviously, you're looking at about 12 to 15% upside if Dan Ives is right on that. So I ask you a question: would you let your financial advisor be a AI chatbot? Maybe, maybe not. I sure as heck wouldn't. But JP Morgan's developing a software that's going to utilize a ChatGPT-like AI to help pick investments. And they actually applied for a trademark for Index GPT. And in the filing, this is what it says. It says it's a cloud computing software using artificial intelligence for analyzing and selecting securities tailored to customer needs. Sounds like what your advisor should be doing for you. So the question is, will this put your RIA, registered investment advisor, broker, stockbroker, whatever you want to call them, usually they're RIAs, registered investment advisors, out of business? I don't think so. Some, yes, that refuse to incorporate artificial intelligence into their strategy, yes, they will likely put out of business, but they'll probably put out the pasture well before that. You think about robo-advisors, that's been around for what, 15 years now, maybe a little bit longer, and they really haven't taken off. I mean, yeah, they have a decent amount of money on them, but the robo-advisors, they've struggled in time, so that never really took off. So I don't think this will happen anytime soon. But again, I think it's a way that investment advisors can increase productivity because their research assistants could do so much more work through ChatGPT versus the old school way of doing it. So the ones that know how to adopt that and innovate with artificial intelligence, I think it will come out on top. So I think it's a great opportunity. Again, it's kind of like Darwinism. The survival of the fittest, I think, will be the end game here when it comes to AI, ChatGPT, and the future of investments. So the last section I want to punch into here is what can be considered like the safe way to play AI, and that's through data centers. And a lot of these are listed as REITs, real estate investment trust. And a couple of players here to look at, but keep in mind when it comes to what's going on right now with artificial intelligence and all the data and the analysis of the data. Excuse me. What it's just there's so much out there, and we've seen a huge growth in data centers over the last 10 plus years as the amount of data has gone basically parabolic. But with artificial intelligence now, that's machine learning creating more data by the second at a faster clip than we've ever seen. Not only that, but having the computing power to be able to analyze that data in a useful way means we're going to need so many more servers, so many more data centers all over the world. Some need to be closer to areas than others. This is going to be a big, big boom, regardless of who the winners are when the chips are of the AI or the computer systems with AI. This is going to be needed across the board. Some of the big names out there, one is symbol DLR, and this is a digital realty trust. Stock topped in early 2022, up around $180 a share. So fell down below 90. We're at 102 right now, as you can see here on the chart. DLR is about a $29 billion company. Year to date, it's flat. It's flat to up maybe 2 or 3%. It has a dividend yield of 4.9%. A lot of that has to do with the fact that the stock price has come down so much that the yield has gone up. And in the recent earnings call, they came out and they noted that and this is from Powers, their CEO. He said the bigger picture on AI is that this is an incremental major wave of long-term demand that will certainly need to have proximity to the major data that sits today. He went on to say that he believes AI will power another wave of demand for data center capacity at a time when it's still capitalizing on a wave of growth from digital transformation. So really that's going to create two major tailwinds. The one that's already going on top of the next wave from the artificial intelligence that will push the need for data and data analysis. So I agree with that. As mentioned, stock got hit quite a bit, but one may want to put an eye on. Again, nothing here is a buy or sell recommendation. Even a bigger one, probably you want to call it the biggest here in the U.S., trades here in the U.S., is Equinox, and the symbol is EQIX. And this is a $68 billion company. You can see here in chart, it's held up much better. It's about 13% year to date, held up much, much better than DLR. A little bit more of a diversified company. They have a lot of huge clients. A little bit over 2/3 of their customers have revenues greater than $1 billion. So it kind of gives them a bit of a safety net, because when you have big customers like that, you're not worried about small companies coming and going as economic fluctuations happen in the economy. And about 13% have between 100 million and 1 billion. So you're looking at over 80% of the revenue comes from companies that make at least $100 million a year. They have about 16% revenue growth year over year in the first quarter of 2023. It's pretty impressive. They had record net bookings, still strong activity going on. It looks like they have about 50 projects underway across 37 markets in 25 countries. So that's impressive for a company this size. And again, one of the bigger players. The dividend yield's not as high. We're really not buying this for its dividends, about 1.85% right now. So the dividend yield's not as high. But again, they have not only do they own some of their locations, but not all of them. They own some of them. The other ones that they don't own, they have at really good fixed rates, and the average lease maturity of these are about 20 years, greater than 20 years. The average borrowing rate for this, 2.13%, obviously much lower than the 10-year right now. And 96% of the debt that they have is at these fixed rates, which is great. So it does lower the overall risk of interest rate risk and continued borrowing risk, as you're going to need in this industry. Going on the smaller range, we have DigitalBridge, and this is not a REIT. This is a pretty interesting company. It's considered really an asset manager. Symbol DBRG, as you can see here, pretty ugly stock chart. It's fallen from about $34 in early 2022. We're about 12 and change right now. Held a $10 level a few times, about 13% here year to date. Not much of a dividend yield at all, 0.3%. As I mentioned, about $2 billion market cap. It's really an asset manager, an alternative asset manager, not your typical asset manager, because they invest primarily in data centers, cell towers, fiber optic networks, really anything to do with digital infrastructure. And in 2015, the stock was as high as $100 a share. So it's down almost 90% from that level. They do have some non-core assets that they own about 10 to 15% each one, data center operators, where one's called Advantage SDC, one's called DataBank. Company said they're going to try to sell those by the end of the year. That will really help lessen the debt level that this has and get rid of that. So that should help the company going forward. But it's a kind of a weird business. There's not a lot that we can really compare it to. But they will raise funds, going out to like third parties and raise funds. They take that money and then they put it into the development, or they'll just buy out digital infrastructure assets, as I mentioned, data centers, cell towers, fiber networks. So it's a play on that, but it's a little more intricate and a little more complicated of a business. You really need to dive into it. I didn't take the time, to be honest with you, to dive into all of it. And again, nothing is a buy or sell recommendation either way, but I haven't taken any time to dive into it. But this has, again, been listed by a few people out there as potential plays on the boom for data centers. Two more stocks here. One is Iron Mountain. This is an interesting company because I've followed it for a long time. Symbol is IRM. It's been around a while. It's been around since I think 1951-ish. And back in the day, it's very similar to what it does today, but it would secure very important records. But it was all paper back then. So they had these big warehouses where they take your files and keep your files for you. Come pick things up. You've seen them where they come shred stuff at the office. Document imaging and offsite tape storage back in the day. Remember the tapes that you'd have? And now it's into data centers and digital archiving. This is one of those more steady companies. You're not seeing huge growth. You're seeing both top line, bottom line to mid, high single digits, and really going forward more of the mid single digits. But what I like about this is you don't have as big of the risk. I look at a chart here, folks. It's held up very, very well. And I want to show you kind of the long-term chart. And again, this company's been around for a very long time, Iron Mountain. Public in this iteration of it since the late 90s, from $4 a share up to about 53 right now. This is the kind of company I think it's a nice core holding in your portfolio due to the fact that you don't probably have nearly as much risk. You're not a direct play on data centers, but it's a really good indirect play on it, and just really for data storage in general. And the last is one of the other trillion-dollar companies out there, and this is Amazon. Because of the Amazon Web Services, AWS, which is obviously a cloud-based service that provided by Amazon, and users, they buy space on there for their data. So this is obviously a play. They have about 120 physical data centers out there in over 20 countries, and they plan to add more, obviously, in the future all around the world. So again, another way to look at it, not a direct play by any means, much more of a retailer in my opinion, but AWS does make up a bigger portion of Amazon than most people assume when it comes to revenues. And last but not least, if you're looking for an ETF, I do not think this is the way to go personally, but there's a Global X Data Center REIT and Digital Infrastructure ETF. That's a mouthful, symbol VPN. As you can see here, hasn't really done much over the last couple years since went public back in 2020. Not one I think is best play out there for you, but one that you could look at, obviously. So lots of ideas here today, a lot that we covered in today's show, but a lot's happened over the Memorial Day weekend. A lot's happened since our show last Tuesday. I want to thank everybody for watching Thursday's show, Jim Records. About 80,000 views right now. So if you have not checked that, watch that yet, please go check that show out. Jim Records is one of the legends here in the investment world, something you may want to watch and get a different view of mine. It's not always you want to hear one side of view, different view of mine. And I love having smart, educated, well-spoken people come on, such as Jim Records we had last Thursday. This Thursday, I have another great interview lined up. I'm not going to tell you who it is till Thursday, but we have a great interview lined up for you. Very excited. First-time guest coming on, and we got a lot to talk about. So again, we'll see what the debt ceiling gets done today. So far looking good, but you never know with what goes on in DC right now. Don't forget to like, share, comment on the show. Thank you so much for watching. Have a wonderful rest of your Tuesday. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.